So I will tell you, when I started medical school, I vividly remember one of our instructors talking to us during the first week of medical school, and he said, during the course of medical school, you will learn the equivalent of a foreign language and become fluent in that. And that's just the language of medicine. And really the language of investing and venture capital investing is no different. And at times you can find yourself talking and you're not really aware that you might be using words that you use every day that your audience is unaware of. And several times over the past year or so, I've finished up a session up here. I've gone back to my seat and someone has asked me a question about some of the verbiage I used and some of the verbiage other people are using, and we realized we really haven't explained ourselves. It's the same as the doctor-patient relationship. If the patient can't understand the physician, you really didn't complete the cycle there. So what we're going to do is we got a lot of terms here. We're going to try and go through them. And the best way I thought about going through it would be to go through as an example. So what we're going to do is we're going to start a company. And so this is a drone delivery service here. And so you come up with this idea, you're the founder, and so what really goes on? Well, the first thing you want to do is obviously you want to record your entity. You want to sign it. You want to put it in a journal. Best if you have someone else understand it and sign it as well, co-sign it. Then you want to submit your provisional patent. You want to go ahead and start your LLC, and just like that, you're a founder. But now's where the work starts. That was actually the easy part. Now's where the work starts, because you got to do a capital raise. So first capital raise, always right out of the box, is what we call a friends and family round. And the friends and family round is literally just that. It's you and your friends and your family, and you meet up with the people and you tell them you've got this great idea, and they know you, they love you, they've known you for years, and they buy into it. And these discussions are around your living room sofa, they're on the golf course, they're at the gym, they're wherever you and your friends are at. And what normally happens is you're raising around $100,000 to $200,000. And this is kind of just an entry-level thing. The finance method is what we call a convertible note, because ordinarily the person who your friend or your family says, well, sure, I'll give you $10,000, but how much of your company do I get? And you as the founder, you don't know. How much equity do you want to give away? It's so early. So you kind of kick the can down the road and you do what's called a convertible debt. And so what this convertible note is you say, okay, here's what we're going to do. I don't know how much you're going to get, but the next time I raise capital, you can come in 20% lower than everyone else. So next time I raise capital, you've already made 20% on your money. So 20% is what we call a discount. Very common to have a 20% discount. And then on the other end of the spectrum is what's called the cap. And the cap would be, in this situation, $2 million. So suppose this went great guns and the next round was being raised at $5 million. You would get in at $2 million. So whichever would work out better for you, whether it's a 20% discount or the $2 million cap. And again, these vary, but this is a fairly standard first kind of round. And so that's what you go ahead and invest in. Then you want to know, what's the use of funds? What are you going to use the money for? And frequently at this point, the founder says, I just got to do some market research. I want to make sure I get my official patent, so I want to make sure that's filed. And I want to just get a proof of concept, because this is an idea I have. I want to make sure it's reality. And that's really what the use of funds is. That's what they're going to use the money for. And as far as governance, it's all you. You're the founder and you're in charge of everything. So the next round is what we call the pre-seed round. So pre-seed round, this is still very, very early. The range is, they can vary, but around $500,000 is raised at that point. And who's investing? Well, some of your friends and family may say, hey, this is going great guns. I love it. I like what you're doing. I want to be involved. I'll put some more money in. And so that's great. This is where angel funds get involved. There's oftentimes angel fund groups where a group of common investors will get together and form an angel fund, and they'll invest in these very, very early pre-seed companies. Some venture capital companies invest at this stage, but most wait until they're out of the pre-seed. This is still very, very early. How are we going to raise this money? They want to know how much equity they're going to get. Usually at this point you do a second convertible note. And so the terms are somewhat similar, but a little bit different. Usually that 20% discount, at this point, the cap may be, instead of $2 million, maybe $3.5 million, maybe it's $4 million, but it raises a bit because you've had some advancement here. But now we're adding in this 8% figure here for interest. So what that means is if you invest $1,000 in this and that they don't do a round for a year, that $1,000 is going to grow at 8% interest. So you're gaining interest on your money, and then it's going to convert 20% cheaper than anyone else in that round, or at a $3.5 million cap. So usually interest is added in at this stage to kind of entice the investors. And really the use of funds is proof of concept and prototype. You've got to get that nailed down. So that's what they're going to be working on. And as far as governance, oftentimes it's you as the founder. You might have one of the head angel investors and maybe an individual investor who's invested, on both rounds. So that would be someone who would be involved with you as far as helping run this company and shape it in this pre-seed round. Next is the seed round. And in the seed round, things start to heat up a little bit. So we're looking usually about $1 million or more that's raised that round. Who's investing? Your previous investors obviously are always welcome in. That's always a good sign. If you've invested before and you're investing again in the company, that's a great sign. Now is where venture capital funds really start to kick in, because the seed round, they've showed proof of concept. They've got a prototype. Oftentimes this is demonstrated at a pitch session or a trade show, and they have these sessions out and about, and so they'll line up 15 founders, and they'll come in and they'll pitch that to a group of an audience much like yourselves, and they'll pitch their session, and then when they step off the stage, people who are interested, flock over them and talk about investing. The finance method is now different. At this point, you have what's called a lead investor. And so the lead investor will negotiate a term sheet with you. And I'm going to discuss the term sheet a little bit later, but so we'll just talk about this is a document that really sets the rules of the negotiation, the rules of investing on that round. And usually this round is somewhere around a pre-money of $3 to $5 million. Now when we say pre-money means what's the value of the company on that round before anyone invests. So you could say the pre-money is $4 million. And if you bring $1 million in, then you would say, after the round was over, you would say the post-money is $5 million. So there's pre-money and post-money. So pre-money would be around $3 to $5 million on this round. And the use of funds here is really to optimize that product, make sure you've developed your supply chain, you know where you're going to get your parts for it, you know everything's perfect with it, and you want to start testing the water on some preliminary sales out there and see where you can get that going. The governance is usually still a 3-seat board. It's you as the founder and CEO. Oftentimes you'll have the current, the previous venture capital person or the previous angel investor, but you always will also have the lead investor. So that lead investor who really set that term sheet is the one who says, I'm going to be on the board, I want to be on the board to help govern this company. Seed round, remember the whole thing you want to do is you want to get ready for commercialization, and you want to get this ready to go for commercialization, but sometimes you run into problems. So when you run into problems, you might have to do a seed B round or a seed C round later than that. So what you really want to do is you want to get it to the point you're ready for commercialization before you go to the next level. So you can have these, sometimes they're called seed prime or seed, seed plus. The names vary, but seed A, seed B, seed C is not uncommon. Once you're ready for commercialization, then you get to what we call a Series A. Now, Series A is where a lot of companies start jumping in, because now you're entering commercialization. You've got your FDA approval at this point, if you need FDA approval or whatever regulatory body you have. You've got that, you're starting the sales, and now a lot of people start coming in. So venture capital, this is ripe for venture capital. You also have high net worth individuals who want to invest in this area, or family offices who are investing in this area. Frequently they don't want to mess with it beforehand. They only want to start when it's commercialized. The finance method, again, is the lead investor in a term sheet, which I'll describe in a bit. And the use of funds at this point is you want commercialization, you want to grow your team, you want to flesh it out. Do you need your chief financial officer? Do you need a chief operations officer? Do you need your sales force, your distribution channels? You really want to grow your team, you want to work on marketing, get your talent going, and you want to get them together. So that's the plan here. Now the governance at this point is you as the CEO, and then whoever led the Series A is almost always on the board. So the person who led this round and set the terms says, I'm going to be on the board, I want to help govern this. And then frequently another venture capital lead who you've been working with before. Once you're ready for that and things are going well, you're ready to then go on to what we call a Series B raise. This is frequently, the numbers can change, but you're raising 5 to 10 million. The value pre-money on the company is frequently 25 to 40, around that range. And the people who get in now are oftentimes large venture capital firms. These venture capital firms frequently work together. There are large companies out there. If they've been on companies before, these venture capital firms have worked together. They will share diligence. They trust each other. So if one company is in, they'll frequently call another sister company and say, hey, I'm in this one. It looks like a great deal. I think you should get in it together and let's do this. So it's not uncommon for venture capital companies to work together aligned and co-invest. The finance method, again, is that term sheet that we talked about, and you have your lead investor who will set those terms and really set it for all the other investors that round. The use of funds, pure and simple at this time, growth, growth, growth. You want to drive that revenue, you want to increase your sales, you want to really get your company ready for sale itself. And the governance now has changed a bit. The governance usually is now a 5-seat board. The CEO is frequently at this point not the founder. The founder who came up with the idea is normally not the person, not the CEO to sit in that seat to run a nationwide commercialization strategy. So oftentimes there's been a transfer. That founder may switch over to be a chief technical officer or VP of R&D or some other role in the company to stay involved. But the board is usually the CEO, maybe the chief technical officer. Then you obviously have the Series B lead who led that round, oftentimes another venture capital firm that's been investing. But then you also have this independent industry professional. So you have an independent seat. And this is a critical seat. And the independent seat oftentimes will have someone who has worked in this area and has worked for a large company who might be an acquirer. Now they've retired and they can let you know what the large companies are looking for as you prepare your company for sale. So this independent oftentimes gives you great contacts in industry and allows you to think of things that you wouldn't have thought of otherwise. Just like with the Series seed, if things are not ready and you're running out of money and you haven't become profitable, you could have a Series C, a Series D, and so on. I saw a Series H a few years ago. So these things can carry on down the line like that. And you'll do that until you're really ready to exit and you feel like your company's ready. When that comes is usually a time when you realize that these strategics are asking you for questions, they're wanting to review your lab, they want to come look at your distribution channel, they want to look at your manufacturing. And as this starts to become somewhat overwhelming and the really starts coming in, you'll oftentimes hire what we call a banker or a company that actually works on selling these companies. So we've worked with Guggenheim, we've worked with JP Morgan. I mean, there's a lot of different companies that work with this. Arc Malibu, Nathan Estruth, who's on our board, works for Arc Malibu. So there's a lot of these companies that specialize in selling companies. And you want to find a banker or a company that specializes in your area. If you're in early stage medical and orthopedics, you want to get to the one that knows several contacts in orthopedics. You have your list of maybe 5 of these large OEMs who are looking at you and talking. They may have another list of 5 or 10 that you haven't even thought of. So the first thing you do when you hire this banker is they come in and they learn everything they can about your business. They really go through everything. They talk to you about how you can make changes, improve it. And then they go out and they really work the street. And they talk to other people these companies who might want to pick you up and might want to buy you. And they really work their magic. And then there comes a time when it's a silent auction where they say, okay, October 1st, bids are coming in, and put in your bids on October 1st. The bids come in October 1st, you open them up and maybe take the top 4 from that and say, okay, second round of bids, everybody can get into more diligence. We're going to open that up and the bids are due October 15th. October 15th rolls around, you take the 2 best bids for you and say, okay guys, we got one more round of this and we're going to narrow it down to the best and final offer, and that's due November 1st. And this is not uncommon. It's a stepwise fashion, and the value that you're getting offered for your company oftentimes doubles during this process. So it's a very, very valuable process. Once the final selection is made, you're off to the races and you've sold your company. Now, that's a process. We like running a process. We think it's very valuable for us because the valuation always increases. It's good to have this competitive tension there in the marketplace. So this is what we normally do as we're looking to exit, and this is exactly what Embody did, and we'll hear more about that later today. I've alluded to this. Let's talk about that term sheet. The best way to talk about the term sheet is think about when you're buying a house and you're going to buy the house. One of the things that you talk about is obviously how much you're going to pay for the house. But that's just one of the factors. If you just can't settle in on the value of that house, your realtors are working together, you're working with the seller, you're frustrated. Oftentimes there's a gap there, and you say, well, I'll be honest with you, I don't want to pay that price. I'll pay this price, but you got to give me a new deck on back because that deck doesn't look good. So maybe that gets added in there. Or maybe you want the handrail down to the garage fixed, or you get that fixed, and maybe new carpeting in the living room. So those are things that you're negotiating, and what you're really negotiating is a term sheet. And this is no different. There's literally about 20 items that we negotiated on the term sheet. You've heard me talk about governance. That's when whoever's leading frequently says, I want to be on the board. I need to be on the board because I want to help protect my money and my investors' money and know where this company's going. I want to help lead that. So frequently you'll negotiate to be on the board, and that's not an uncommon feature. As we go down the list, one of the things we often talk about is liquidation preference. Now, no one likes to think about the company going south and not working out, but that's the reality of it. And so one of the things you want to do, if you're leading that term sheet and you're saying, I'm going to set the terms for everybody on this, I want first liquidation preference. So if this goes south and there's assets to be divided up, whether they're patents or whether there's actual physical hard machinery assets, I want to be able to get our money out first before anyone else so I can get that back to my investors. And that's liquidation preference, and that's very, very common. So the next part of that is kind of a subset of liquidation preference is your participation rights. And participation rights are basically saying if there's $2 million to be divided up and I invested $1 million, after I get my $1 million back in the liquidation preference, I want to participate with the rest of the investors when they split up that $1 million. So if I own 10% of the company and I invested $1 million in this scenario, there's $2 million worth of assets to divvy up. I get liquidation preference, I'll get my first $1 million back, so I'm made whole. Now there's $1 million left to be divvied up among the investors. I want to participate with them and get my 10%. And participation rights are a way we can actually get some extra for our investors. So we got our investment money back and then we're participating again to get a little bit extra. In extreme situations, you can have 2 times participation rights. If they really need a lead, that's one of the things you can negotiate is when everybody's participating on what's left over, I want twice what everybody else is getting. That's a very aggressive term sheet, and we've seen them out there, but participation rights are some of the things that we negotiate. Board seats, let's talk about board seats. We talked briefly about that in governance, but if it's a 5-seat board, we will routinely, when we lead a term sheet, say, we need a board seat because we want to be able to protect our investors, but we also want a board observation right. And a board observation right is incredibly powerful because that allows you to have one of your partners in the board meetings with you, and they can help and they can assist, they can drive value for the company. When it comes down to voting, they aren't allowed to vote. They don't have a vote, but they are able to drive that company and help with that. So Matt Ahern and I are on the CNTR board. I have the board seat. Matt has the board observation rights. Matt contributes as much as anybody else to those conversations in the board. When it comes to a vote, then I have the vote, but it's a very, very valuable position and can really strengthen what you want for your investors. All right, warrants. Let's talk about warrants. So warrants are the ability to buy the company in the future at today's prices. So oftentimes what you'll do is you'll say, okay, you'll work with the CEO and you'll find out what's the pinch point for the company. Where are they struggling? What are they hurting for? And you may be talking to the CEO and the CEO says, man, we just are struggling raising capital. We just can't do it. And you may know that you've got several VC firms that are going to come with you. If you lead, you have a lot of investors who are behind you, and you can help the CEO get their company raise completed. So what you may say is, hey, you know what? I think I can get you across the line. We can get you across the line. And as part of all this, as part of the term sheet, I want 5% warrants. And 5% warrants means I'm going to take 5% of the company right now available for me to buy in the future. So if the company's worth $10 million, and then sells for $100 million, right before the sale or $100 million, you're going to activate your warrant on those 5%. And that 5% costs the company $500,000 or you $500,000 later when you activate it, but you're going to get $5 million in this situation when they exit. So warrants are incredibly valuable, and you negotiate these with the CEO and the board, and if you can find the right soft spot where they're struggling and you have the facility to be able to fulfill that need and get them across the line, warrants are a great way to do that, to reward you for doing that. So if the company goes under, those warrants are worthless, obviously, so it doesn't hurt the company. But if the company hits sky high, they're happy to have set aside 5% or 2% or whatever the warrant is back in the day to then give you at the exit. All right, veto rights. Veto rights are an interesting one because people often say, well, if you only have one board seat on 5, those other 4 board members can gang up on you. What does that do? That does you nothing. So frequently, whoever's leading the term sheet will set this up and say, I want veto rights. And so the veto rights allow you to do that, to veto it and say, it only happens if I want it to happen. And there's numerous things you can veto. We've seen sheets with 20 different veto rights. One of them commonly is the exit valuation. So let's suppose in this scenario, the other 4 board members invested at a $5 million valuation. We come in and we're investing when the company's worth $50 million. Now, a year later, a company comes to buy this company and says, we'll pay you $60 million. Well, the other 4 people on the board who came in at $5 million would love to get 12x on their money and exit at 60. but we got in at 50. We're not in this for 20%. This is not what we're looking for. So you would have veto rights on that. Frequently, these veto rights expire. So you may say, I want veto rights in this scenario. I want veto rights on any sale below 150 million. So if we came in at 50 million and an offer comes in at 120, everyone else on the board may want to do it and you can veto it. If it comes at 160, your veto rights expired at 150, so then it goes. And so that's a negotiation you can set that veto threshold with. But vetoes on numerous things. What about if you're worried if the board is going to vote, every employee a $50,000 bonus at the end of the year? Well, you would be able to veto that. So what about compensation for the CEO? What about if the company decides as soon as your money is in that they want to change focus and they want to build a spaceship to Mars? And that's not what you invested in. So you would have veto rights on a change of direction of the company. It's endless what you could have veto rights on. So you really want to look at this and decide, what are we nervous about? What things do we want to make sure that we can protect? And you want to get veto rights on those. Last thing I'm going to discuss here is pro rata rights. Now, pro rata rights are your ability to invest in the next round. Let's say you own 3% of the company. They do a next round and it's a big round and a lot of VC companies want to come in. Pro rata rights ensure that you're allowed 3% in that round. What you don't want to do is get pinched out by the big guys later on. You're here ready to do this, man. You want to get pinched out on that. So pro rata rights, we always try and assure if we own 5% of a company, we want to have the right. It's not an obligation. We want to have the right to then do 5% on the next round so that we can get in there. Now, the thing about the term sheet is it's only valid for that term. So if you're the Series A lead, that's great. As soon as there's a Series B lead, all these things go away, and that's whoever led the Series B is going to have their own term sheet. So that's one of the reasons why we really want to get in. We want to get governance, get control, and set the stage for us and control it. I'm going to have a quick talk here on IRR and ROI. Okay, so when you're getting a return on your investment, everybody knows ROI. I invested $1,000, I got $10,000 back. You would say your return on investment is 10x, but we would actually technically say it's 9x. Because you invested 1,000, you're getting 10. You invest your 1,000, you want to get your table stakes back, your investment back, which would be your 1,000, and then you made 9 difference. So that's technically a 9x, but everybody knows ROI. I mean, return on investment, how much you put in, how much you get back, that's a common feature. Who wouldn't love a 10x? Everyone would love a 10x. But what if I said you're going to get 10x in 50 years? Yeah, suddenly that's not a cool thing, right? No one wants that 10x, right? That's where IRR kicks in. And IRR is internal rate of return. And so think about your money building during that time at a certain rate to a certain value. So it's like compounding interest. It could be at 10%, 12%, 30%, and that's what your money is going to grow at year after year. So that's IRR. IRR really helps you evaluate an investment over time. As I said, the return on investment sounds good, but if it's over an extended period of time, it doesn't sound so good. So IRR kind of shrinks that. IRR is harder to think about, especially on very, very short investments that come back, months or so later. You can have a higher IRR than you would expect, but that helps equate the timeline into all of this. So I want you just to think, I'm not going to do a hand vote. I want you guys to think, we got a 10-year investment, all right? Who would rather have 10x or who would rather have a 30% IRR? So your money's going to grow at 30% per year. So just think that over. And at 10 years, those are identical. So that's just something to keep in your mind. So if you invest 1,000 and 10 years later you get 11,000, so you got your money back plus 10, that's a 10x. That's also the same as 30% growth over 10 years. So it's just something to think about as you go through this. It's just a way to kind of connect those two. But again, this is on a 10-year timeline. Obviously, things are different on a shorter timeline.
Sean, thank you so much again. This was excellent. Thank you.